Very good. Welcome, everybody. Welcome to the FibStalker Giuseppe Street weekly show. This is the first show of this new year. Happy New Year to all of you. Happy new, great, and profitable 2017. And today is Wednesday, January the 3rd, and it's 7 p.m. EST. We have this show every week at 7 p.m. and we will continue throughout 2017. As you know, this show is hosted by me. I'm Giuseppe Basile, also known as the FibStalker, and this show is usually in two parts. The first part is educational section, and the second part is the review of a number of pairs. And today we're going to review the euro dollar, the US dollar Japanese yen, and then the New Zealand dollar Canadian dollar, and the pound Australian dollar. I've been trading some of this in my trading signal room, and I'll talk about that very briefly later on. For what concerns the educational part, we are currently looking at a series of our 10 steps to successful trading. And today I'm going to touch on step 4, which is following a plan. And if you are watching the recording, I will show charts, and I want to warn you that all the material here provided is for your general information only. As you know, risk management is trading number 1. It's very, very important that you understand that trading Forex, as well as any other security, carries a high level of risk. Okay, it might not be suitable for everyone. So if you're watching the recording, please stop it and stop the recording and read the full disclaimer. I want to talk about myself. Really not a lot has changed since last year. I keep collecting hours of market exposure. This year I'm going to add 1,000 plus hours, and I'm very happy of how the 5th session of my FibStalker coaching program started in November is going. And I recently launched a new service. It's a trading signal service, and you can get 1 free month. I'll give information about that. If you want to reach me, it's FibStalkerTrading.com, and you can write always an email to me at Gmail. There's also a free newsletter you can jump on, and you'll get a lot of free information, video reviews, and more. All right, so into the content of today's webinar. And as you know, we are looking at the 10 steps of successful trading, and we covered step 1 to 3 so far. Today we're going to talk about following a plan, step 4. This is very important. If you are going to like what you see here, you can also link it to your account, online Twitter account, and that's greatly appreciated. So as I mentioned before, if you want to learn a little bit more about how I look at the markets, you can come and take this free course, 6 hours video course here at winningwithaugust.com/start. So thank you and welcome to FibStalker Trading, Simple Trading for All. And let's look at the agenda of these 10 steps. Remember that trading, we mentioned that trading is really much a process that produces an outcome, and it requires you to get onto a journey. Now you can play trading at different levels by following someone else trade signals, or taking a responsibility and learning skills to understand how price really moves. So these 10 steps are about how to become successful, and you will remember that again, it's a process. We want to get from where we are now to where we're gonna want to be, and in order to do that, we need to change our beliefs, behaviors, and routines as well. Now, a lot of difficulties traders, new and experienced traders have is that in the years they have created beliefs about how the market works that are wrong, that are not grounded in the way modern market works. So that's one of the problems. You also mentioned that we have to treat trading as a business, not as a way to, now it's not as a substitute of a job, because it is not. Of course, it can generate a constant flow, but in average, that flow will be constant. Sometimes there will be less opportunities, sometimes there will be more opportunities. So a lot of people fail because they fail to learn skills that will serve for life, while they are only looking for quick bucks. And that's, if you have that mindset and you want to be successful in trading, you have to change that mindset. Well, that will make you one of the 95% of traders that lose consistently because they never learn skills. So, as we mentioned, understanding risk and reality of trading, the mechanics of value trading edge. And today, we're going to talk about the execution of a simple trading plan. Now, this may be something very, very simple, but the reality is that a lot of people, the majority of people, when put in front of a simple trading plan, and I'll give you an example later on, they're not capable of following it. Okay, so if you lack the discipline or of following a simple trading plan, then definitely trading is not for you, because even if you don't want to develop a full understanding of how market works, and you just want to stop here at the 5th step that can make you still profitable and very profitable in trading, you need to learn how to execute simple trading plans. So this is very, very important. So how do we stick to the plan? And why we need a plan? Now, executing a trading plan is simple, but not easy. It's not easy because a lot of people can just not discipline themselves to enter only at the right price, to put the stop only where the stop is being suggested, and to execute the plan as it was initially thought. Now, a problem that a lot of people have is also that they don't understand risk and money management. So lots of traders trade fixed lots. Now, when you trade a fixed lot, and we looked at that also when we spoke about risk management. When you trade a fixed lot, let's say you trade one lot, right? And you're trading futures, and that translates in a variable pip risk, because sometimes that one lot will correspond to 10 pips, and other times it correspond to 100 pips. So the the problem is that it is important to know where what the pip risk is, because that's what specifies and defines your maximum loss. So if your pip risk is 100, then, and you always play one lot, obviously, you're going to lose 1,000 depending, or more, depending on which pair you are trading. If your pip risk is 10, your loss is 100. So as you can see here, the dollar loss, the dollar risk, it's not fixed, but it's variable, and we don't want that, because if you're let's say if your 1% of your account it's $100, in one case you're risking 1%, in another case you're risking a very, very high 10%. And that's something that absolutely you have to avoid. So one of the problems that I have noted by working with lots of traders and students, and also subscribers to the trading signal, is that they do not execute the plan properly, and they do not accept a small risk, And unfortunately, they also do not accept a large risk sometimes, because if they trade a fixed lot, let's say one lot, and they risk $1,000 on that account, let's say 10% on a 10K account, what happens is that if they don't accept that large risk, they're in trouble as well, because if they never contemplated the fact that they can lose 10% on their account, they will not act and exit when their stop loss is it. So as you can see, and we spoke about this also in step 2, accepting risk is very, very important. Now, I like what Alexander Elder said and wrote, every clown can put up a trade. Of course, Alexander Elder was making reference to identifying a setup, but this applies to simple trading plan execution. So obviously entering with a limit or stop market order is not complicated. What is complicated is entering exactly at the prices that are suggested in a trading plan, because if you do that, then obviously you calculate your position properly, then you know that you're limiting your risk to that limit that you set. And my limit is 1%, and I'll explain in step 5 why even a small risk like 1% on each trade can lead to very good results when we leverage our results using money management. That's something for step 5. And also because we reach objectives in trading with money management, and we will talk about this next week. So basically, the mechanics of trading, entering and exiting, is not complicated, and there are a lot of tools that can help you doing that, CTrader or add-ons to MT4. And of course, if you're trading using other platforms, TradeStation, CMC, and so on, you have that capability built into your platform. So why sticking to a trading plan is not easy? So what's the problem there? Well, the main problems are lack of confidence, not acceptance of risk, and we spoke about accepting small risk and accepting large risk. The reason why small risk is not accepted, because people say, well, I have to put a lot of work into it, and I'm gonna only risking 1% of my account. But they don't understand the importance of money management and the fact that we reach objectives through money management. Other problems that get in the way are ego. I know it already. I don't agree. I know better. I don't take this trade because I know better. I think this is not a good trade, and sometimes so ego comes into the picture if you have to take a trade. And the problem is that whenever you have a trading edge, and we spoke about this in step 3, if you don't take all the trades, you're not able to actually reach the statistics and reach the objectives and statistics of the trading edge. So you're not able, if you don't trade all the opportunity, you may miss the opportunity that actually provides you 3 units of risk in return, or 5 units of risks. So if you are selective and you just let your ego or lack of confidence and acceptance of risk, which should not be a problem if you're able to position yourself properly, if you're able to calculate the position sizing, then you will not be able to reach the expectancy of a trading system. All right, so you need a leap of faith if you don't understand the method that is behind the recommendation that you're asked to trade. And that's again another reason why you should always attempt to build skills. And this is a business after all. So if you want to go for the long haul, if you're in for a long haul, you're not going to execute someone else's signals forever. And you're not going to get rich in 1 year. So if you really choose trading to be a business, to be something that you want to do, then you need to build skills. And the problem of piggybacking someone else is that once that someone else is gone, you're left without anything. So the mechanism of order entry and management will not stop. In fact, they're very simple, and that's typically not what stops people. What stops people is that they take too high of risks. They do not understand risk and money management. And even when they lose money, actually, they get back into the game. The problem is that if you get back into the game and you have not built skills, then you are doomed to repeat the same mistakes. So overconfidence, of course, will stop you, and that's perfectly obvious, because you have to build some kind of confidence in what you are actually trading. So, what is the solution? Well, what we should do? Well, if you decide to go for the long haul, if you're in for the long haul, then you need to take lower risk trades. You have to paper trades. You have to study past results for the services that give you the past performance, and give yourself time to understand how you function as well with that method. And you can also enroll in a coaching program, particularly, there are many of them. I offer the FibStalker Methods coaching program to build those skills. So again, we had, so we reviewed these points here: lack of confidence and acceptance of risk, ego, and this can get into the in the way. Now, when we look at the trading plan has the following components. There are 8 components there. Some others say there are 10, but then we enter into multiple trading systems, as well as asset allocation, deciding how much we dedicate to each market. But there are at least the following parts, and this can be further reduced here. But whenever you want to trade, you have to, of course, to decide which market you're going to trade, and maybe why. The setup, which is the setup is really a series of rules, analysis criteria to take action, and that can also give you the direction, long or short. The entry, it's really a level. The entry should be very, very simple. It is just a level, and there has to be a simple concept around how to get involved. When price gets to that level, if it's a limit order, then you get in. But whenever the price goes through that level long in the direction of the trade, that's a market stop and entry, and that's the way you get in. So the entry should be really a price level and just a basic mechanism how you're going to enter it. And then there's another price level, which is the stop loss, which tells you which price level the market has proven you wrong, and that's very, very important. There are some re-entry criteria. Some of the systems can have re-entry criteria. I don't use re-entry criteria when I'm stopped out from a setup. I actually reevaluate the market and basically come up with a different or a similar setup, but after complete analysis to see what has changed. It can be exits or partial exits. I have 3 different types of exit: the risk-free level, the target number 1 and target number 2. And of course, there is, if you use partial exit, there is also a level, which is the level where you take out the position and when you complete the trade. And finally, position sizing, that can be calculated very simply if you use a percentage fraction of your account, and you should be doing that and leave the bad practice of virtually trading full lots. Okay, so these are the components. Now, there is a minimum number of components if we take out some of the components here which are not really needed: a re-entry, the position size, which is implied by the pip risk, which is the distance between the entry and stop. What you get is something much more simplified here, and this is typical trading plan I'll give in my trading signal service. And as you can see, there is an entry below, which is 1 pip below the level, the stop above 1 pip above the level. And if you want to get more sophisticated, you can use the average. You can use an average value which is different depending on what market you are trading here. And there is a risk-free level, and risk-free, if you remember, we spoke about this, is basically the level where I will remove half of the position, and this gives us the opportunity to keep riding half of the remaining position, the half remaining position. But if we are stopped out, we are stopped at break-even plus cost of trade. And then there is typically one or more target. In this case, there is one target. For each trade, I will calculate the reward to risk without using the risk-free level, and the adjusted reward to risk. It's basically the reward to risk when we exit only half of the position. And the adjusted reward to risk, it's very simply calculated with a formula that takes into consideration the normal reward to risk if you would not exit half of the position at the risk-free level, plus 1, and the sum is divided by 2. And that's the way we calculate this adjusted reward, which is obviously lower than the reward that you would get in the full trade. But there are reasons, several reasons, to use an adjusted reward risk and using a technique that exit half of the position at the risk-free level. All right, so this is a typical plan, and if you want to look at how we trade, you can come at winningwithalgos.com/signals, and you will get a free 1 month trial, and you can look at how we generate this signal. So this concludes the educational part of today's show, and thank you for watching. Okay, next I'm going to review 4 markets, and I'll start from the euro versus the US dollar here. If you like this review, please feel free to link it. Now, the euro dollar, we have seen this market moving lately in a very technical way. I'm going to remove the dump money here. And you will remember that we had a 50% retrace, scalable of bringing this price into the, and this is the weekly time frame, into the into that 112.30 area. This was tested the day after the US electoral vote, and we saw this market actually getting into that first target, and then we have an inner move here, and then eventually reaching that target. So as you can see here, in the last 3 weeks and at the beginning of this week, this market has been taking profits on top of this level. But before doing that, at the end of last week, we also saw this market trading the extension. In fact, if you remember well, I indicated to 106.10 an area of resistance, and in fact that market, that area has acted as resistance, pushing price more than 20 pips lower here, as we can see on the weekly, and it's much more much clearer here on the daily as well. So we saw participation. It came with a spike. Price never revisited for a second, for a proper setup during the German and UK Open in Europe, that level, and price continued lower. But around that second target I showed you before, there was again participation. So this market did not continue lower, and that was an indication that this market was not ready to move lower, and one of the reasons is that the dollar index is correcting. It might be correcting laterally or downwards, and depending on which kind of correction we get in the dollar index, we may get this price retesting again the 106, or even moving higher into 107 and even higher prices here. So if you stick with me or you come in the trading room, I'll be able to tell you exactly how to get involved. I got involved in this market lower because that level was no opportunity for me to take advantage of the 106.10, but I entered at a lower price and then took partial profits when I saw this market reacting again. Of course, we are looking for lower prices into 102 as well as parity here. It's not going to happen, at least not yet. And this market, has two levels now. I'm going to watch. One is going to be retrace at 107.40, and the other one is going to be the full 50% retrace from the highs we saw in April here to recent lows. And depending on how strong that correction is, we might get this price moving into 107.40 or even higher, actually 109.70. So we might get a reaction anyway at 107.40, and we're going to see whether that gives us the opportunity for this free trade, or we're going to wait for this price to get into 109.70. All right, so this is the review for this market, and again, if you like the review, you can actually link it. So next, I want to review the US dollar Japanese yen, and we are stalking this market. We'll be doing this week and next week on the also on the winningwithalgos.com/signals, which is the trading room. So if you want to try and look at it, review this market. So the US dollar Japanese yen, in a way, it's kind of mimicking what the dollar index is doing here, and it is currently heavily starting a correction here. So this could continue and encounter the 115.45. That's where we would see some initial resistance. If this market keeps breaking here, we're going to see 45 and 90 very, very quickly. Now, this market has the potential to move towards 113.07, and that would be, or even 112.07, and these are the areas that we're going to look for a potential continuation of the trend here. Dollar index is behaving similarly here, although the dollar is actually still there is still a dump money area in this market. Okay, so going back to the US dollar Japanese yen, there'll be an initial move here, and if this market continues lower, we could trade the reaction into the 113.10 area here, and then see what happens to this price. I believe there is the opportunity for this price to actually continue higher if he gets participation in this area. Watched by smart money and dump money, we might get the opportunity to trade into 121 and even 125.70. So as you can see here, there's going to be a trade that can really make the year, and it might take several months for that to develop if he gets participation from these areas where also smart and dump money are, and bring price to previous highs that we saw last year in June. Okay, so this completes the review for the US dollar Japanese yen. Next, I want to review the New Zealand dollar Canadian dollar, which is another trade we took in the room this week, and this market so far is behaving well. We actually entered below 93.63, and this price continued lower, retested lows, but this market has the potential to keep moving lower into 90, 70, 90, 80 here, which would make this 5+ reward to this trade, swing trade actually. So this is something that could be traded in a very, very relaxed way. Now, this market comes higher and to challenge our entry point, we're going to look at how this market is going to behave if and when it gets into 93.22. If the market finds participation in that area, then we're likely going to see a continuation lower here, of course, with the very, very strong Canadian dollar. This is one of the reasons we recommended this trade here. So the 92 area could act as a strong support here and potentially generate profit taking from the previous measure move here. But our plan for this market, unless something changes, would be to keep it into 90.80. All right, so this concludes the review for the New Zealand dollar, Canadian dollar. Next and last, I want to review the pound versus the Australian dollar here, and this market has actually traded. It's a very technical market. When we review the weekly here, we can see that there was a very good and technical sequence of measure move. We saw this market last year, 2016, trade a 50% retracement here. It was 202.67, which were priced into first target. And imagine where that profit taking came from. Well, it came from the second target for obvious reasons. And in the last few weeks and couple of months, this market has been testing the next measure move short, which is now trading. The reason why it is measure move short has not pushed price lower quickly is because there was some dump money support, and at the moment we entered this trade at 107.19 here, and so far this market is continuing lower. Our target for this trade, if it can break below previous lows here, yesterday lows, the 168.53 is going to be 166.50 area here. And if that level is broken, we should be able to see this market moving into the level which just never traded yet in this sequence of measure move higher very quickly. So this is what we're going to wait for in this market. And as you're seeing here, there is also resistance from dump money. We will see if on the 4-hour time frame and daily, and we will see if that is capable of holding this price lower for a retest of 168.61, and then eventually a continuation lower. All right, so this concludes the review of the pound versus Australian dollar. Again, I want to give you my contacts here, FibStalkerTrading.com, and if you're interested, I opened my enrollment for the February-March session. This will be the 6th session of my FibStalker Master Coaching Program, which is a high-performance a program of 12 months with all the information given to you in the first 1 to 3 months. So you are enabled to trade and apply the setup that includes also the trading signals as well, so you can really learn while you earn. So this is this is an online program. I do some offline activities locally here, but this is an online program. So again, FibStalkerTrading.com. If you want to get in contact, FibStalker@gmail.com, and you can contact me. And if you jump on the free newsletter here, you can get all the information, all the videos, and the also the free course, the free 6 hours video course, as well as the webinar and a lot of other content that can help you become a successful trader. So thank you very much for watching this first show of the year. Happy New 2017, and it is my wish that this will be a great year for you, your loved ones, and a very profitable year if you're an active trader. Thank you very much. Bye bye now.